While most people were distracted by daily market noise, earnings headlines, election cycles, inflation prints, something far more structural moved in the background. It wasn't a crash, it wasn't a speech, it wasn't even a single headline that dominated the news cycle. It was a policy decision, implemented quietly, that altered the incentives for trillions of dollars in global capital. The core event is simple to state. A major policy shift changed the relative cost and risk of holding assets in one jurisdiction versus another. In practice, this meant that large pools of capital, sovereign funds, global banks, pension managers, multinational corporates, suddenly faced a new equation. Capital that once earned an acceptable return with tolerable risk no longer did. The rational response was not protest, it was exit. What makes this moment dangerous is not that money is moving. Capital always moves. What makes it historic is the scale and the speed. When a $50 billion hedge fund reallocates, markets notice. When $500 billion in corporate cash management shifts, currencies react. But when the incentive structure changes for institutions managing $10–30 trillion collectively, the result is not a trade. It is a regime change. Most people miss this because it doesn't look dramatic at first. There is no single red candle on a chart that explains it. The early signs appear as small anomalies: a persistent bid in foreign currencies, slightly wider funding spreads, a steady drain in certain reserve accounts, an unusual pattern in cross-border settlement data. These are plumbing signals. They do not trend on social media. They show up in footnotes and weekly tables. The forcing mechanism is policy-driven asymmetry. A change in regulation, taxation, settlement rules, capital requirements, or rate structure creates a wedge between where capital sits and where capital is safest or most productive. When that wedge widens enough, even conservative institutions are forced to act. A central bank reserve manager is not speculating. A pension fund CIO is not trading momentum. They are responding to a structural deterioration in risk-adjusted return. What's at stake is not a single asset class. It is the funding base of an entire system. When capital exits at scale, three things follow. Local liquidity tightens, the cost of capital rises, and asset prices must reprice to attract replacement money. That affects mortgage rates, corporate borrowing, government deficits, and currency stability. A 50 to 100 basis point rise in long-term yields can add $150–300 billion in annual debt service for a large sovereign. A 10% currency move can change the import bill for an energy-dependent economy by tens of billions. These are not abstract numbers. They flow directly into household costs and employment. This is not a prediction of collapse. It is an explanation of mechanics. Capital is not emotional. It is contractual. It moves when the math changes. And right now the math has changed. This analysis is educational only and not financial advice. Markets involve risk, uncertainty, and volatility. Nothing here should be interpreted as a recommendation to buy or sell any asset. Always consult qualified professionals before making financial decisions. Now, here's the part most people miss. Once capital begins to leave for structural reasons, it rarely returns quickly. Policy can slow it, rhetoric can mask it, but the flow itself becomes self-reinforcing, and that is where the real story begins. To understand why a single policy decision can trigger capital flight at historic scale, you have to look at how global money is actually deployed. Large institutions do not invest the way individuals do. They operate inside rule-bound frameworks, regulatory capital ratios, internal risk budgets, currency mandates, collateral requirements, and duration targets. A pension fund managing $400 billion cannot simply hold less of something because it feels risky. It must rebalance when a parameter changes. The mechanism begins with relative return. Capital flows toward the highest risk-adjusted yield that satisfies legal and regulatory constraints. If a government bond yields 4.5% with low volatility and zero capital penalty, while a foreign equivalent yields 3.0% with higher currency risk, the choice is obvious. But when policy alters that equation, through taxes, capital controls, settlement restrictions, reserve requirements, or regulatory treatment, the entire curve shifts. Consider a simplified example. A global bank holds $200 billion in sovereign bonds yielding 4.0%. The policy change increases the capital charge on those holdings from 0% to 5%. That effectively reduces the bank's return on equity. A 4.0% yield with a 10x leverage structure might produce a 12% ROE. Add a capital surcharge and that ROE drops to 8%. Meanwhile, alternative jurisdictions still offer 3.5–4.0% yields with no penalty. The bank does not debate ideology, it reallocates. This same logic applies to corporate treasuries. Multinationals manage hundreds of billions in short-term instruments. If overnight policy changes create uncertainty around access, taxation, or settlement, even a 25-50 basis point disadvantage becomes meaningful. On $500 billion, 0.50% equals $2.5 billion annually. That is a board-level number. The plumbing matters. Modern capital moves through repo markets, FX swaps, custodial chains, and collateral agreements. A policy that changes how assets can be pledged, rehypothecated, or cleared raises the friction cost of holding them. Friction is invisible to retail investors, but decisive to institutions. A 10 basis point increase in funding cost across $5 trillion in balance sheets equals $5 billion per year. That alone can flip internal models from hold to exit. Once the first layer of institutions adjusts, feedback begins. Selling pressure raises yields or weakens the currency. That changes mark-to-market values. Those changes trigger risk limits. Risk limits force more selling. What began as a rational portfolio adjustment becomes a flow event. This is why these moves often appear sudden. The policy may have been announced months earlier, but capital moves when the implementation date arrives, when systems update, when legal opinions finalize. On that day, compliance desks send instructions, not traders. The orders are mechanical. A historical parallel helps. In 2018, when regulatory and trade policies altered the treatment of certain cross-border holdings, offshore dollar funding costs spiked. The 3-month cross-currency basis widened from near zero to 50 basis points in some pairs. That signaled stress. It was not a crash, but it forced banks to shrink balance sheets and pull liquidity. Within 6 months, global trade volumes slowed, and emerging market currencies fell 10 to 20%. The mechanism is not fear. It is arithmetic under constraint. Either the system absorbs higher funding costs and lower asset prices, or capital leaves to where the math still works. There is no third option. And when the actors involved control tens of trillions in aggregate, even a 5 to 10% reallocation represents the largest capital movement in modern history. Every capital exodus has a common misunderstanding attached to it. People assume money leaves because investors lose confidence. In reality, the first movers are rarely emotional and almost never speculative. They are institutions that cannot remain where they are once the rules change. The story is not about fear, it is about constraint. The first group under pressure is global banks. Their balance sheets are governed by capital ratios, liquidity coverage rules, and stress test assumptions. When policy changes alter the treatment of certain assets, through higher risk weights, new compliance burdens, or uncertainty around settlement, those assets suddenly consume more balance sheet capacity. A bond that once cost zero capital might now cost 3 to 5%. For a bank running with 10 to 12% equity, that is not cosmetic. It forces a choice, either raise new equity or shrink the asset base. Raising equity is expensive and slow. Shrinking is immediate, so banks sell. The second group is sovereign and quasi-sovereign reserve managers. Central banks, stabilization funds, and state investment vehicles collectively manage on the order of $15–20 trillion. Their mandate is preservation, not performance. The moment a policy introduces political or operational risk into an asset class, it violates that mandate. Even if the yield remains attractive, the option value of exit becomes uncertain. For a reserve manager, that is disqualifying. They reduce exposure quietly, over weeks or months, through intermediaries. There is no press release. There is only a steady absence of rollover. Third are multinational corporates. Large exporters and importers routinely hold tens of billions in operational cash. They are not chasing yield, they are minimizing friction. If a policy change raises the probability that funds could be delayed, taxed unexpectedly, or restricted during stress, treasurers diversify. A firm with $40 billion in global cash may shift $5–10 billion in a quarter. Multiply that behavior across hundreds of firms and flows reach hundreds of billions. Then come the leveraged actors: hedge funds, relative value desks, macro funds, and proprietary trading groups. These entities sit on top of the system. They use repo, swaps, and futures to amplify small spreads. When the underlying plumbing becomes unstable, funding rates rise and collateral haircuts widen. A trade that earned 1% annualized with 5x leverage suddenly loses money. Prime brokers issue margin calls. Positions are cut. What looks like speculation leaving is actually forced deleveraging. This is where the binary choices emerge. For banks, either reduce foreign exposure or breach regulatory ratios. For reserve managers, either diversify or accept political and liquidity risk. For corporates, either move cash or risk operational disruption. For funds, either unwind or fail margin. There is no neutral position. A brief historical parallel illustrates the pattern. In 1997, Asian currencies came under pressure not because investors panicked, but because currency pegs became mathematically unsustainable. Banks and corporates with dollar liabilities realized that rolling short-term funding was no longer certain. They reduced exposure, reserves fell, pegs broke. The crisis was the visible end of a process that began months earlier in funding markets. What is similar today is the asymmetry. Certain jurisdictions now carry policy risk that cannot be hedged cheaply. What is different is scale. In the late 1990s, cross-border financial assets totaled roughly $20–25 trillion globally. Today they exceed $130 trillion by most estimates. A 5% reallocation then was a few hundred billion. A 5% reallocation now is $6–7 trillion. This is why the movement feels unprecedented. The actors are the same types, bank, states, firms, funds, but the base is an order of magnitude larger. And crucially, these actors are not choosing between stay and speculate. They are choosing between compliance and violation, between solvency and breach, between mandate and failure. Once those choices appear, the exit is not ideological, it is automatic. To understand why this event is real and not narrative, you have to step away from headlines and look at the balance sheet math. Capital flows are not philosophical. They are mechanical outcomes of mismatches between assets, liabilities, and incentives. When those mismatches widen, flows follow. Start with the stock of global cross-border capital. By most international estimates, banks, funds, and institutions now hold between $120 and $140 trillion in foreign assets. Roughly 40–45% of that sits in a single dominant financial jurisdiction. That concentration is not ideological. It emerged because for decades the return, liquidity, and legal clarity made it optimal. Now introduce a policy change that raises the effective cost of holding those assets by even a modest amount. Scenario A, mild adjustment. Assume only 5% of foreign-held assets are reallocated over 12 months. 5% of $50–60 trillion, 3.0 trillion in gross outflows. Scenario B, moderate adjustment. Assume 10% reallocation as banks, sovereign funds, and corporates diversify. That implies $5–6 trillion in capital movement. Scenario C, stress adjustment. Assume 15–20% reduction driven by regulatory pressure and funding stress. That produces $7.5–12 trillion in exits. These are not speculative numbers. They are simple fractions of existing stock. Now map those flows onto market capacity. Daily FX turnover is about $7.5 trillion, but that is gross volume, mostly intraday. Net structural reallocation is far smaller. Long-term balance of payments adjustments of $50–100 billion per month already move currencies materially. A persistent $200–300 billion per month shift can reprice a major currency by 10–20% over a year. Bond markets face similar limits. Net foreign buying of government debt in large economies often ranges between $300–600 billion per year in stable periods. Flip that to net selling of the same magnitude, and yields must rise to attract domestic replacement buyers. A 75 to 125 basis point move in long-duration bonds is not extreme under those conditions. Consider the debt service effect. If a sovereign rolls $7 trillion in debt annually, and average funding costs rise from 3.5% to 5.0%. That is an additional $105 billion per year in interest. Over 3 years, that compounds into $300+ billion in new structural deficit. That deficit must be financed, usually by issuing more debt at the same elevated rates. This is how flow becomes feedback. On the private side, corporations feel it through credit spreads. If foreign demand for investment-grade paper falls, spreads widen. A move from 120 basis points to 180 basis points on $4 trillion of outstanding corporate debt adds $24 billion per year in interest expense. That money comes out of capex, wages, or margins. Inventories amplify the effect. Many commodity and manufacturing systems operate with 30 to 60 days of working stock. If currency shifts or funding stress raise import costs by 8–12%, firms either absorb the hit or reduce volume. Both paths transmit into growth data. The crucial point is this: the system was built on continuous rollover. Foreign capital did not need to grow, it only needed to stay. When even a small percentage stops rolling, every layer above it must reprice. This is why normal expectations fail. Models assume stable participation. They assume that if yields rise, buyers appear. But when the buyers are exiting for structural reasons, higher yields do not attract them back. They confirm the risk. In a regime shift, price is no longer the clearing mechanism. Policy is. And when policy creates asymmetry, math enforces migration. Not tomorrow, not in one headline, but inexorably, quarter by quarter, balance sheet by balance sheet. When capital begins to exit for structural reasons, markets do not respond in a clean, linear way. They respond in waves. The first wave looks like noise. The second wave looks like volatility. The third wave reveals that something fundamental has changed. The earliest signal is spread behavior. Funding markets move before asset markets. Cross-currency basis widens. Repo rates drift higher. Swap spreads stop behaving normally. These are not headline events, but they are warnings. They indicate that balance sheets are becoming scarce. When banks become more selective about deploying capital, liquidity thins at the margins. Then come the visible price effects. Bond markets typically react first. Net foreign selling does not crash prices in a day. It erodes demand at auctions. Bid-to-cover ratios soften. Primary dealers absorb more supply. Yields drift higher, even on good news days. A 10-year yield that used to fall on weak data now holds flat. That is regime change behavior. It tells you the marginal buyer is no longer price insensitive. Currencies follow. Structural outflows do not cause a one-day collapse. They cause a persistent bias. Rallies fade. Support levels fail quietly. Over months, a currency can lose 8 to 15% without a single crisis headline. Import prices rise, hedging costs increase. That feeds back into corporate margins and inflation prints. Equities respond last, and most dramatically. Higher discount rates compress valuations. A market trading at 20x earnings with a 4% long bond yield may reprice to 16, 17x if yields move to 5.5%. On a $40 trillion equity market, that multiple shift alone represents $6 to $8 trillion in paper value. That does not require a recession. It requires only a higher cost of capital. This is where feedback loops emerge. Rising yields weaken equities. Weaker equities tighten financial conditions. Tighter conditions reduce risk appetite. Reduced risk appetite accelerates capital withdrawal. At the same time, leveraged structures unwind. Risk parity funds reduce exposure as volatility rises. CTA models flip from long to neutral. Option dealers hedge gamma by selling into weakness. None of these actors are making macro judgments. They are responding to inputs. Liquidity vanishes in pockets. ETFs decouple from NAV. Credit ETFs trade at discounts. Bid-ask spreads widen. Markets look irrational. In reality, they are behaving exactly as designed, prioritizing survival over price discovery. What should observers watch? In rates, auction coverage ratios, swap spreads, term premium estimates, yield curve shape beyond 2 to 10 years. In currencies, persistent trend in trade-weighted indexes, FX swap basis, hedging cost for exporters, importers. In credit, investment grade and high yield spreads, new issuance volume, covenant quality. In equities, correlation spikes, sector dispersion, volatility term structure. In plumbing, repo rates, money market fund flows, central bank facility usage. The key is persistence. A single volatile week means nothing. A 3-month pattern means structure. Why does this often look chaotic? Because markets are built on the assumption of continuous liquidity. Prices reflect not just value, but the expectation that someone will always make a market. When that assumption weakens, everything reprices at once. Assets that were never risky behave as if they are. This is why the reaction feels disproportionate. A policy tweak does not cause a crash. It removes the margin of safety that prevented one. The system transitions from abundance to scarcity, and in scarcity regimes, correlation rises, leverage falls, and price becomes subordinate to access. Observers often say, "This makes no sense." But structurally, it makes perfect sense. Markets are not reacting to news. They are adjusting to a new cost of capital and a new availability of balance sheet. Once that shift begins, it rarely stops on its own. It either runs until prices clear the new regime or until policy intervenes again. When a regime shift begins and capital flows, the timeline is not measured in minutes. It unfolds in layers: operational, financial, and finally economic. Understanding that sequence is what separates noise from signal. Next, 24-72 hours, markets react to surface catalysts. Data releases, speeches, headlines. These may cause sharp moves, but they are not decisive. What matters is whether plumbing indicators change. Watch repo rates, FX swap spreads, and overnight funding conditions. If they normalize after volatility, the system is still absorbing. If they remain elevated, the process is active. Next 1-2 weeks. Primary markets reveal truth. Government bond auctions show whether foreign participation is weakening. Corporate issuance shows whether risk is being priced higher. Currencies reveal bias. Do rallies fail quickly? Are hedging costs rising? This is where structure becomes visible. Next 1 to 3 months. Balance sheet behavior appears. Banks reduce intermediation. Money market funds shift allocations. Central bank facilities see altered usage. Asset correlations rise. Volatility remains elevated even when prices stabilize. That is the signature of a regime transition. From here, three scenarios emerge. 1. Base case. Gradual repricing. Capital continues to diversify at a controlled pace. Outflows run in the range of $150–300 billion per month. Yields drift higher by 5,100 basis points over a quarter. The currency weakens 5 to 10% on a trade-weighted basis. Equity multiples compress but do not collapse. Growth slows, but recession is delayed. Confirming indicators: consistently softer bond auction demand FX trends that persist despite good news. Credit spreads widening slowly, elevated but stable funding costs. This is the managed transition path. Markets adjust, policymakers monitor. Volatility remains above the old norm, but the system holds. 2. Stress case, disorderly adjustment. Outflows accelerate toward $400–600 billion per month. Funding markets tighten. A major intermediary pulls back. Yields gap higher by 150–200 basis points. The currency falls 12 to 20%. Equity markets reprice sharply as discount rates jump. Liquidity vanishes in segments of credit and ETFs. Confirming indicators: sudden spike in repo or FX basis failed or weak sovereign auctions. Sharp widening in investment-grade spreads. Emergency liquidity facility usage. In this path, something breaks, not necessarily a bank, but a market function. Policymakers are forced to respond. The response may stabilize conditions, but at the cost of credibility or future flexibility. 3. Relief case. Policy offset authorities neutralize the incentive shift. Capital charges are eased. Settlement risk is reduced. Yield differentials narrow. Outflows slow below $100 billion per month. Markets stabilize. Volatility compresses. Confirming indicators: rapid normalization of funding spreads. Renewed foreign participation in auctions, currency stabilization across weeks, compression in credit spreads. This path requires a deliberate reversal of the asymmetry that caused the exit. It is not rhetorical. It must change the math. The crucial insight is that these scenarios are not about sentiment. They are about structure. Markets will follow whichever path restores equilibrium between risk, return, and access. Big picture, this episode exposes something fundamental. Modern markets are not driven primarily by valuation. They are driven by balance sheet availability. When policy alters who can deploy capital, and at what cost, it rewires the entire system. The real economy feels this through higher borrowing costs, slower investment, and currency effects. Financial markets feel it first, because they are the transmission layer. This is why single policy decisions now carry outsized consequences. In a $130 trillion cross-border system, even small rule changes propagate globally. Nothing here is a forecast or a recommendation. This analysis is educational only. Markets are complex, uncertain, and risky. Consult qualified professionals before making any financial decisions. But the mechanism is clear. When the math changes, capital moves. And when capital moves at scale,